Hello everyone, welcome back to the Velocity channel where this is your bridge to financial freedom. Listen, I know that when you clicked on the thumbnail, it was unbelievable, okay? But the reason I have a blank whiteboard is because I want to show you from beginning to end, no edits, all right, how you can legitimately, legally, lawfully, ethically turn your loan, any amortized loan, any loan, into your checking account. All right? So make these loans your checking account. Do like the banks do. Turn the loan into an asset. We're going to show you right now. Before we get into that, please like, share, and subscribe so that everyone around the world can know the power of velocity banking. Are you ready? All right, folks, listen, we have the loan, okay, over here on this side, okay? And we're going to go ahead and say that it's at 10,000, all right? Now, loans have what? Interest, don't they? So let's say that loan is at the 10% interest. I want you to see all of this here. I want you to see all of this. And so let's say you have, what is it? Maybe $400 each month, okay? $400 each month you're paying on that loan. And of course, with a loan, you have that $400 split up, don't you? All right. And so you already know how that goes. 10,000 at 10%, $400 each and every month. But guess what? That $400 is not going towards the principal. It's getting split up. Let's just say $200 goes towards, now you know that this is far from the truth, all right? But it's about this, all right? $200 goes towards the interest, okay? And then $200 goes towards the principal. We're just going to do this for easy math because you guys are not going to believe your eyes. You probably won't believe your ears, all right? So 200 to the interest, 200 to the principal, all right? Most likely the bank is actually going to be more, right, than the principal, but let's just leave it there. Now, we have something called a line of credit. A lot of you who are already experienced in velocity banking may already know where I'm going with this, but I want you to follow me here because I'm going to share with you something perhaps that you don't know. Let's say you have a line of credit, okay, of, let's say, 12,000, okay? You've got a line of credit at 12,000. Let's just say you haven't used it yet, and that's going to be at 21%, right? And you haven't used it yet, but if you did use the 12,000, of course, it would be at $600 each and every month, okay? Let's say that. Now, CJ, you still haven't gotten to the point where I can turn my loan into a checking account. Could you get to that? I sure will. But before I do, I want you to picture this. What if I told you that almost everything you've been taught about money and how to pay loans back is a lie? You've been taught that you can save your way to wealth. Has that been the case? So what I'm bringing to you right now is something that real estate investors and business owners have already known. Does that make sense? So please take this not only with a grain of salt, but don't believe my stories. Don't believe anyone's story. Believe the numbers. Now, I haven't stopped the video at all. I want you to believe the numbers. All right? Here we go. How many of you know when you have a line of credit, you can pay things from that line of credit? But what many don't know is that when you pay a loan with a line of credit, you actually make a transfer. Because this bank and this bank are in the same game. And when you make the transfer, right, this loan no longer exists. So let's say you're like, you know what? I've got $12,000 on my line of credit. I'm going to utilize $10,000 and eat this loan up. So that now I no longer have this loan. You don't have to worry about the principal and the interest getting split up all unfairly on the amortized loan. Okay? Because remember, with the loans, even though it's at 10%, it's 10% amortized. That's a closed-ended deal. Versus the 21% simple interest. They have two different calculations. If you don't believe that, look up on ChatGPT. All right? Ask them, hey, does amortization and simple interest, are they different? Okay? So let's do this. Let's say we're going to go ahead and launch $10,000 towards this principal. We're going to pay that loan off. Right? Paying it completely off. But now we've got a challenge, don't we? Now we've got $10,000 on the line of credit side. Well, let's say you have income coming in of $5,000 and an outgo. An outgo of $4,000. You thought I was going to say $3,000, didn't you? All right. That leaves you with $1,000. And of course, this fluctuates each and every month. That's okay. What you're going to do is you're going to put your paycheck inside of this line of credit. Yeah, but CJ, I still need to pay my bills. You're going to pay your bills from your line of credit. So that this income goes inside of the line of credit and the expenses come from the line of credit. So what's happening here is that it'll go in and then of course it'll go out, right? These are the expenses. Remember, your expenses are $4,000. So if you're making $5,000 each and every month and you are spending $4,000 every month, what does that leave? $1,000, right? Okay, all right. Remember, your balance was $10,000. Now it's $5,000. But when it goes back up, right? It's going to go back up to, right, $4,000 up because of the expenses. $9,000 total. So what's $9,000? Okay. Divided by $1,000. What do we do here? Cross out those zeros here. It is 9 months until you are out of that loan. Now, how long would it take you to pay off $400 one way, and that's away from you, remember? Okay. How long would it take you over here? Way longer than 9 months. You just turned your loan, okay, by making the transfer, okay? Hey, I want to pay from my line of credit the $10,000. I want that loan gone because I want more cash flow for me. I want more cash flow for my family. I want more cash flow for my community so that I can do different things and I can have some more Lebensraum, if you will. So you're not going to be paying the $600 each month. So that $600 goes to you, right? But that $1,000 is staying in there each and every month. There's no late payments. You don't even have to write a check. You just transfer it. Listen, it's not going to be direct deposit. Okay, so you got to transfer from your checking account to your line of credit, which is your new checking account. So you're going to go ahead and pay that line of credit, and then your expenses are going to come from there, and then you're going to just continue that cycle only for 9 months. And what will you have again? Because remember, we only used $10,000 of the $12,000 we could have used. That's right. We'll have the full $12,000 again. So if you wanted to get another loan so that your credit could report that, and so that you could get on the good side of the lenders. They love it when you're on their good side. You know what happens when you're on their good side? This number goes up. That'll never happen with the savings account. That'll never happen with the checking account. I got to ask you, is that happening with your IRA? Is that happening with your 401k? I'm going to go ahead and get out of the way here. Is it happening, folks? Can you do this? Yes, you can. Because money is money. And when you take the $10,000 from your line of credit, perhaps you have also some cash. Do you have a check, an access check, a convenience check, if you will? You can do that as well. Go ahead and pay that loan off. What you've done, you've just transferred it. Okay, there's no more loan, so you don't worry about the interest rate. We're not worried about the interest rates anyway, because we're paying our loans, we're paying our lines of credit the velocity banking way. So that 10%, that 20 or 30%, we don't pay that as velocity bankers. Does that make sense? All right, folks, listen, I want to see you on another video. Let me see what video you want to see. You want to give me a problem. Maybe it's an unsolvable problem. I'm going to go ahead and solve it. God bless you. You take care, and we will see you in another video.